What is credit analysis and why it matters? Two companies make the same profit, one survives a crisis, the other goes bankrupt. The difference is credit analysis. If you want to grow in finance, whether as an investor, banker, analyst, or student, understanding credit analysis is not optional. In this video, I'll explain what credit analysis is, how professionals use it, and why it matters more than profits. What is credit analysis? Credit analysis is the process of evaluating whether a borrower can repay their debt on time and in full. The borrower could be a company, a bank, or even a country. Unlike equity analysis, which focuses on upside, credit analysis focuses on risk. The key question is simple. What can go wrong? Who uses credit analysis? Credit analysis is used by banks before giving loans, bond investors before buying debt, credit rating agencies, risk managers, even equity investors who want to avoid disasters. Anytime money is lent, credit analysis is happening, formally or informally. What do credit analysts actually look at? Credit analysts focus on three big areas. Debt. How much debt does the borrower have? Is it short-term or long-term? Cash flow. Does the business generate enough cash to service that debt, especially during bad times? Liquidity. If cash dries up temporarily, does the company have enough liquid assets to survive? This is why a profitable company can still fail, because profits don't pay debt, cash does. Why credit analysis matters? Most financial failures don't happen because revenue disappears overnight. They happen because debt becomes unmanageable. Lehman Brothers was profitable until it wasn't liquid. Many companies look safe until interest rates rise. Credit analysis helps you avoid companies that look good on paper but are fragile. Understand how economic cycles affect businesses. Think defensively, like a professional. Credit analysis versus equity. Equity investors ask, how much money can I make? Credit analysts ask, how can I lose money? That difference in mindset is what protects capital. Conclusion and takeaway. Credit analysis is about survival first, growth second. If you understand debt, cash flow, and risk, you understand finance at its core. In the next videos, we'll break down credit ratios, real company case studies, and how analysts actually think. If you want to grow in finance and learn credit the professional way, subscribe and comment below. Should we analyze a real company next?